Welcome back to Click Capital, your go-to channel for the latest market data, analysis and charts. And we had a bit of a mixed day out there today. Mega cap tech saved the day again, but we did come off in financials and banks. They actually made new lows today. Came off in healthcare, energy and utilities as well, but overall pretty flat day. Most sectors except for tech did make lower highs and lower lows after we had a pretty good gap up this morning. Over to economic data. Jobless claims came in a little mixed. We're actually lower on the 4-week average. Continuing was a bit higher and initial was a bit lower. So still no signs of a deteriorating labour market just yet. And new home sales actually surprised a lot on the upside. So apparently the housing market isn't that bad right at the moment, but I think there's a bit of lag in these numbers because we did see mortgage applications have been dropping to new lows, and with higher rates and tighter bank lending standards, I think that'll create a bit of a drag on those numbers going forward. Tomorrow we've got durable goods and some PMIs coming up to give us a bit more of a read on inflation. Over to fear and greed, it actually just ticked down 2 points today, so much the same. Not a huge amount of fear out there at the moment. Over to options, and we saw a lot of contracts traded in NVIDIA. NVIDIA is not normally number 2 most traded. It was up 2.7% today, with actually majority of puts being bought. So there is a lot of people betting against this thing. Everyone can see how overvalued it is. But this could be liable to a squeeze up to 300 if everyone keeps loading into puts. We can see here the put call ratio is 1.1, which is pretty elevated out there today. Also saw Block come off a lot. We'll get into a bit later. Same with Coinbase. Netflix actually popped up. First Republic came off another 6%. Still a lot of people trading options there with consistently high put call ratios in that name as well. Over to dark pools. Not much change there. Still sitting around the 50% level, which is a bit neutral and slightly supportive of the market. Corporate insiders did taper their purchases yesterday and sales popped up. And relatively speaking, corporate insiders have been keeping up somewhat elevated sales on the past month or so. Fed fund futures probabilities were actually ticked up a bit today. So rates came off again. We're now at a 67% chance of pausing in May. So the bond market is really trying to call out Jay's bluff here and saying, we're definitely going into a recession. You're definitely going to have to pause soon and then even start cutting rates in a few months. So that's an interesting divergence and dynamic playing out in the bonds market there. And here's an interesting chart I thought I'd show you today is the gold to S&P 500 ratio after a yield curve inversion, the 2-year average performance. So this blue line here is the gold to S&P ratio during the 73 to 74 recession and tech bust. You can see it got up to 147% after 2 years. And the yellow line is all prior times when the yield curve first inverted by 70% since 1970. You can see the average was 72%. And here we are today, not quite 20%, about 5 or so months after we've inverted. And after we get through today's news, I'll show you this ratio on the charts and I'll show you where we are compared to history and what my thoughts are on that. Still no news from Warren Buffett. Doesn't look like he's going to be stepping in to save the day. Nothing coming out from him, and I'm sure the White House would love it if he would, to help calm things down and get a big vote of confidence from the most respected investor out there. Real estate billionaire Sam Zell warns that hot inflation isn't going away anytime soon, says the Fed screwed up. I actually follow this guy. I think he's really good and he's kind of underrated. He's made some really good calls in the past. I can show you here an article I actually dug up and it was time-stamped September 2008, and he said a recession is likely in 2009. And I remember him coming on and saying that, and he was actually selling a lot of real estate. And he bailed out a lot before the big real estate blow up. And so he's saying pretty much the same thing again. He said, when you spread out free money for years at a time, you create significant drag. And I just don't see how we are going to avoid a slowdown as that whole process comes to an end. I think the Fed screwed up by allowing zero interest rates to go on too long. I think we are just beginning to pay the price for that. It would be nice to say that it would be great if the Fed got lucky. I've been around for 50 years and I've never seen the Fed get lucky. So I totally agree with what he's saying. the Fed's just gone so hard on both ways. They went hard on tackling the global financial crisis with zero rates and quantitative easing for so long and created, the biggest record everything bubble that we've ever seen in history. And now they're going really hard on hiking rates at an unseen pace as well. So the Fed's just creating more volatility in markets. They're amplifying the bubbles and crashes. And I'm pretty sure this guy's going to be right again in that, inflation is pretty sticky. Maybe monetary policy is just not going to kill it on its own. Maybe it's much more structural than we all realize. Moving on, American households likely to sell $750 billion in stocks, says Goldman Sachs. So with personal savings rate coming down and higher bond yields, and the market's still kind of weak, and if the people start losing their jobs, people are going to, sell some of their stocks to live, and you can get a higher yield in safer bonds. So this could actually, thinking about supply and demand, we could see a lot more stocks actually be supplied to the market this year, especially if we see unemployment tick up. That's going to be the real indicator, and I think what Jay's waiting to see tick up before he starts, talking about pausing and all that. Bank turmoil ramps up pressure for $900 billion of property debt. So the regional banks, they were big lenders to commercial property debt, and that sector's been in trouble for a while, and amplified by the COVID lockdown, the whole work from home thing, offices and that vacancy rates. So they're carrying a lot of these assets on their books that are already in trouble. And the banks have got, all this huge, flight of deposits. And I mean, we're not even in a recession yet. We've still got unemployment at 3.5%. And the banks are already struggling. Imagine once we do get into a recession, what's going to happen. Maybe we could see 07, 08 all over again, as much as we don't think we will. Who knows? The numbers are there for it to get really bad. And Fed may be too late to ease stress on debt-laden firms. So I agree as well. As credit cycles can be self-perpetuating and kind of having like a snowball effect. And once they get going in one direction, it can be hard to turn around. So the cost of credit for smaller companies and banks is going to go up, and it's going to be harder to get, and that's going to flow through to the economy for sure. And just to show you an example of how often the Fed officials get it wrong, this is time-stamped from June 2017. Fed's Yellen expects no new financial crisis in our lifetimes. So she said, thanks to the reforms of the banking system, 07 crash, we're never going to see anything like this again. Here we are, not even 6 years later, and we're in one right now. Bill Ackman warns US economy headed for train wreck after last Fed hike. I don't think much of Bill, but I think he does make a good point here. When combined with the higher cost of debt and deposits due to rising rates, consider what the impact will be on lending rates in our economy. The longer this banking crisis is allowed to continue, he wants the government to step in with our taxpayer money, of course, the greater the damage to smaller banks and their ability to access low-cost capital. Trust and confidence are earned over many years but can be wiped out in a few days, especially now in the digital world. So I think there is a point, like these smaller banks are going to be struggling, and their cost of credit is going to go up, and they have to offer higher rates to customers to stay, because if you can earn 4% from JP Morgan or 4% from a small regional, you're better off going with JP Morgan. It's way too big to fail. And, so it kind of is all the money's going to the top. But what does that mean? We're supposed to only just live with like 4 or 5 banks. So it's kind of like a structural change now, and everyone's realizing this $250K deposit insurance thing doesn't really work, and it's kind of got a messy Fed backstop if they need it. Yellen's going back on forward saying, they will stop the whole system from falling apart, or they won't. And so the whole thing's kind of in a bit of a flux at the moment. And where all the dust settles is anyone's guess. This could still get a lot worse. And we're seeing that, and we saw that today with Yellen saying the Treasury is ready to take additional actions if warranted to stabilize banks. So did a bit of a U-turn on what she said yesterday, saying that they won't give blanket deposit insurance across the sector. And banks started selling off hard, and so she's come out to change her tone today. So that's not a good sign, in my opinion, when you're seeing the Treasury go back and forth like that. Block shares plunged 16% after short seller Hindenburg says Jack Dorsey's company facilitates fraud with his Cash App. I mean, that's pretty well known that, Cash App is used for criminal things, and Hindenburg seems to have a really good effect on stock prices. Whenever they release a short report, it really affects the stock. So it'll be interesting to see what comes out of that if the Feds want to look into that a bit further, and we'll see what happens with that. Swiss bank, central bank, just to hike their interest rates 50 basis points, even after doing a forced marriage of Credit Suisse to UBS, going through a banking crisis, and they just hiked 50 basis points. And so did Bank of England. They just hiked 25 basis points just after the Fed hiked 25 basis points. So that's the big difference between this banking crisis and the one back in 07 and 08. I remember back then, it was January 2008. I was skiing up in Whistler, and I remember coming home from skiing and seeing the news update streaming across the TV. It was Fed does emergency 25 basis point cut, and I was like, gosh, this is happening. We'd been seeing the headlines build up, and it kind of reached this kind of boiling point. And that's what the Fed did back then. They aggressively cut rates and quantitative easing, but now we've got a banking crisis with hot inflation that the central banks are trying to get on top of. So I don't see how that's supposed to be better this time. Hot inflation, banking crisis, and the fastest pace of hikes ever that always ends up causing some sort of crisis or something breaking. And don't forget, in history, whenever inflation goes above 4%, it never comes back down until the central bank rate goes above inflation. So in England, they've got a huge gap. They just took their bank rate to 4.25, and they got inflation running annual run rate at 10.4. So over in America, that gap's only about 1.25% at the moment. But there's still gaps all over the world between central bank rates and inflation rates. So the central banks have to really get on top of inflation, and maybe this banking crisis should help to bring inflation down with the flow of credit, but maybe it's more structural and sticky with food and energy costs and what's going on in Eastern Europe that's affecting that. So central banks are going to be in a super tough position. If we do see unemployment tick up, we go into a recession, but we've still got structural sticky inflation. That's a really tough spot to be in. They normally want to, drop rates to help the economy, unemployment. But high inflation has significant long-term lasting effects as well. That has to be properly dealt with. Okay, so over to the charts today. SP500, we did tag up just above 4,000 here at 11 a.m. And we just see on the SPY here, we almost come up and touched our 50-bar VWAP. So after the Fed decision yesterday, we initially rallied, but then sold off pretty hard into the close. Bounced this morning about 1%, rallied up until 11 a.m., then sold off. We tried to bounce, but that was sold off as well. And that was pretty much the theme across all indices, except NASDAQ. Mega cap tech saved the day again. Couldn't make new lows compared to yesterday. Unlike all the other indices, which did. They all made lower highs and lower lows. And Russell even took out its last week lows as well. Internationals still in oversold conditions and just kind of holding there. DAX holding up really well, just below its 50-bar VWAP. But all of them still under their 50-bar VWAPs, except China, that's been doing different things in the last couple of days. Over to volatility, and volatility actually got up a bit there today. VIX got up to almost 25, and we weren't really selling off that hard at all. It was kind of like a flat day, so I thought that was interesting. And there was a few more puts being bought there today. We saw that in the put-call ratio going to 1.13, equity only going over 101. So that has been a bit of a change on the last couple of days. And bond market volatility still really elevated here with the MOVE index at 151. Breadth bounced a little bit, but we're still flat down here. Only 18% of stocks above their 50-day average and 38% above their 200-day average, and not many stocks making new highs either. So the breadth is still really weak. It's just mega cap tech that's really holding this market up. And we can see the growth sectors, actually first defensive, actually broke out a little bit here today. And equal weight SP versus normal SP still getting slammed down here. And high beta versus low volatility had a good day. And look at this in growth versus value, just breaking out here. And we can see this in the Qs. And look at the Qs versus small caps. Look at that run. That is just huge. We go out to a weekly chart. So we're coming back up to in August 2020 and coming back up to the highs as well in December, just before the bear market started. So this outperformance by tech has just been spectacular to watch, but how much more can it last? Small's still getting absolutely slammed compared to bigs down here. The Russell with the regionals is just showing no signs of stopping. Now gold versus SPY, that's that chart I was going to show you of the ratio of gold versus SP500 when we get a yield curve inversion. So let's just go out to a 3-month chart. And so we last inverted, I'll show you on the yield curve. We started inversion in October 2005. So we go back to the gold SP chart. October 2005. You can see it was right around 0.4. So if we look at how much it performed after there, from when the yield curve first inverted, we got up almost 300% in the next 6 years to when the ratio peaked in July 2011. And so if we just go and look at a gold chart, we know it underperformed since then, and obviously the SP 500 just went parabolic. So looking at that ratio chart now, if we just zoom in a bit here, we can see that we've kind of been in a bit of a box consolidation mode for a long time now. Almost 8 years, you could call it. So that's a long period of consolidation. I think now this looks good to come back up. There's no reason over the next 6 years we can't see this ratio back up to 1.3, 1.2 after we've had a huge period of outperformance from stocks relative to gold. So I really like gold here, short, medium, and long term, and I'm positioned in all my portfolios for that. And if you haven't already, subscribe to this channel, because this is something I'm going to be following and watching for years. So I'll keep you updated on that. But let's keep moving on. Thought I'd show you gold versus treasuries as well. And that's actually just broken out. So gold's actually been outperforming bonds here for a couple of years already and looks to have really good momentum, which is interesting. And look at the yield curve today. We're shot back up here to minus 0.4. So bond market's really saying, there's a recession on the way, definitely. And we can see that in credit spreads coming off. And look at the 2 years trading down here for 3.82. We're kind of testing this kind of bottom it looked like it was making over the last week. Same with the 10-year. If we go out to a 3-day chart, and we can see it's had this support around this 340 level. So we've just come back down into that now. So it's going to be really interesting. The bond market's saying, no, Jay, you're wrong. You're going to have to pause and start cutting in a couple of months. We've got a recession coming. And Jay, like all central banks, they're still hiking rates, even in the face of a banking crisis. So they're pretty determined on inflation. But we really need inflation to start coming down in a few months. And once unemployment ticks up, then they can pause. But you got to remember, when they do pause and cut, that's when stocks typically sell off. So if we go back to the SP 500 chart, I'll just quickly show you on the monthly chart, and then we'll add the Fed funds rate to it. So we can see they paused back in mid-19 and started cutting, and there's a bit of a delay, but the stock market, although it was quick, the COVID bear market, it still came off 35% really quick as the Fed was cutting rates. And if we go back to the prior bear market, we can see the Fed started pausing in mid-06, and then they just started dropping, and then again a little bit of a lag effect, and then we had that huge sell-off in the GFC where the S&P fell over 55%. And again here in 2000, the Fed paused mid-2000, and the market got a little bit of ahead of it this time before it started cutting. And look, as the Fed cut, we all remember that tech crash, 50% on the S&P, even worse for NASDAQ. So if we were to pause up here and cut, stocks are still really elevated. When you look at it on a 3-month chart here, we're still really elevated. Even if you add the log on, we've still had this huge period of parabolic growth, elevated. And now if the Fed wants to pause and cut rates, that's not going to be good for stocks. That's showing that the economy is getting weaker. And the Fed is cutting rates into a recession, which is not good for stocks. And I mean, you just look at that 3-month pattern up there, these kind of shooting stars we've got on this 50% retracement. So far, we've only fallen about 26% from the peak. And you see the last time we fell 35, 57, 50. So this could still have a lot more to go. And that's why I think we could easily see 3,000 this year on the SP 500. And markets typically overshoot. So I wouldn't be surprised if we overshot down to 27, or if things got real crazy down to 2,500. Because looking through history, when we have these huge peaks, that often comes with symmetry on the downside as well. Okay, but let's just keep moving on through the charts here. Back to bonds. So Fed fund futures, they're pricing down. Basically, the market's saying you've got to cut. Treasury's still holding firm here today. I would have thought they would have had a little bit of a better move up, but it was kind of just a flat day out there. High yield coming off a little bit as well. Dollar kind of just holding firm here at this support level. And Bitcoin perking a little bit up here as well. Looks to be consolidating. So whether this is consolidation, I think I've got a feeling we're going to touch 30,000 at some point over the next week or two. Whether we bounce off that or not, I'm not sure. But I think this should be a consolidation up here. I mean, we did have that big bearish engulfing candle yesterday, but this is a big momentum thrust on volume here. And I think there's some good reason for it. So we'll be keeping an eye on Bitcoin. You can see on our trend candles here, we are bullish. So for now, we're in an uptrend on Bitcoin. Over to Ethereum, and that's just holding up there too in a bit of a consolidation pattern. Commodities flat as well, and looks to have still holding below this big support zone we've been watching. And even though we've got copper above its 50 bar VWAP, it's kind of looking a little bearish here. I've got a bit of a hidden divergence going on and in this resistance zone as well. So we're watching copper as an indicator of economic activity. If this thing rips higher, that would be more bullish for markets. But we have had this down movement over the last couple of weeks. So if that holds, that's more bearish for markets. And look at gold breaking out again on volume. You've been hearing me say since this pullback in here under the 50 bar VWAP, I do like gold and I am positioned that way. I like to think of gold as a gentleman's Bitcoin, and I prefer to hold a hard coin rather than a digital one myself. Oil's coming off and it's looking weak here. So that's weak for economic activity. Our hidden divergence is getting real weak here. So that's not good overall for the energy sector. Moving on to stock sectors here today. Just having a quick look through. ARK's come off. So two of their biggest holdings are Block and Coinbase, and they both got hammered today. But mega cap tech, we can see this here in the tech sector. We put on a bit of an inside bar day, and look at semis actually making new highs here today. And if we go out to a weekly chart on the semiconductor ETF, so we have this turn zone around here around 255, and it looks to be moving to the top of it. But if we go out to a 3-day, I mean, these support and resistance zones are not an exact science. So this could still turn here. We are putting this big divergence on the medium-term chart here. And just to put it into context here, we'll just zoom in. And we have had quite the move off these October lows. We are up since 57%, which is a huge move in under 6 months. So that's a pretty big pullback for semis there. Moving on, we had retail come off today. A lot of retailers broke down today on volume, made new lows there on the sector. And there's the energy sector coming off a bit as well, looking weak in oil and gas trading down here. Gold miners had another good day, up 2.4%. And regionals, ouch. We just took out new lows on regionals today, and the financial sector just sneakily broke down there. So you've heard me say, I'm not sure if this is a bottom. I thought we might have a little bounce up and then fall off again, but this thing looks like it's just continuing to slide. And I'll show you the regional stocks in a little bit. Defensive stocks just holding in there a little bit, and utilities actually came off and made new lows. So we do have a bit of divergence coming on here. And the theme of this year, has been getting into growth, tech, and out of defensive, I think that could turn at some point. We are coming down to lows on utilities, the October lows, which I think could be a good risk reward for utilities there, especially if rates keep coming down. Then this 3.2% dividend yield is going to start looking a lot better. And if we are going into a recession, then short utilities, long tech is not the trade you want to be in. It's kind of the opposite. Moving on to stocks, BlackRock just kind of holding flat. Same with JP Morgan and mega cap tech. Just holding up there, but still putting in a bit of a topping formation here on Apple. Microsoft as well, just kind of a bit of a holding pattern. There's Amazon and Google inside bar day, so we couldn't take out yesterday's highs. So these turning process can take a few days and it's often a bit messy, but I still think mega cap tech is overextended up here, and especially so with semis. Nvidia just looks to be running inside bar day here, and I hope this thing goes up towards 300. We can short it up there. We'll just look at a 2-week chart and we'll just do a Fibonacci retracement of this move here. So you can see we're already in the golden pocket of a 61%, 78% retracement, and the top of our buy sell band around 290, so around 78% retracements, 295. So I'll be looking for a short around 290s up to 300. I'll be looking for some sort of, shooting star or divergence pattern, an exhaustion, and as I think that could be a good risk reward on a short if we get up there. Okay, moving forward, Netflix was up 9% today. Really big move. Some good data come out of Canada, and I think they got upgraded on analysts speaking positively about them, so the market really liked that. And Tesla just kind of sitting flat here, kind of just chopping around its 50 bar VWAP and a bit of indecision, so we could be coming up for a big breakout here with Tesla either way. Over to Coinbase, came off hard today, 14%. So SEC served it a notice, Wells notice, they're going to charge it. They're coming after this thing. This is not good for a US listed crypto exchange. They're probably going to have to go offshore with this, because I think after FTX, the government's just going to come down hard on these players in America at least, and not let this happen again. However, I don't know if it have that much effect on the price of Bitcoin itself, because you don't need Coinbase. You don't need to pay exorbitant fees to Coinbase to get a hold of Bitcoin and put it into your own cold storage. So I think this affects Coinbase more than Bitcoin overall. And overall today, meme stocks were a bit mixed, not much happening there. And First Republic coming off 6% today, and PacWest down another 8%. And the banks, look at Bank America falling to new lows, and Citigroup as well, and Wells as well. So still a really weak price action in the banking sector there today. Okay, so that's a bird's eye view at the market. Back to the SP 500. So again, just more of this kind of thick sideways price action. We can't seem to move with conviction in any one direction. We did make lower highs and lower lows today on all the indices except the NASDAQ. Bit of an inside bar there. But I still think we're overextended up here. But if a recession is coming, this could be a good spot to get short some high growth names and high beta. And on the medium term chart, we've still got the SPX in a downtrend. And I'm still going to stay positioned as such, 100% net short with high beta, cyclical growth, a little bit of tech, and long bit defensive treasuries and gold. Okay guys, that's all I got for you today. Thanks again for tuning in, and hope to see you tomorrow. Cheers.